this off. So this is we're with Phil Willett at Epstein Schneider. He's just walking us through a sort of training on a 1040 tax return. So this is a personal income tax form for an individual or individuals. And so he's just going to kind of walk us through line item by line item just to show us, what these are, if there's any, what they are specifically, and then if there's additional places we need to understand to get more information about them. So thanks for taking the time, Phil.
Yeah.
I want to dive into the first ones, and I'll just kind of ask some questions as we go.
Yeah, and kind of actually going back to the top there, this is a, I'll just assume, go from the very basic here, that a joint return is most common if you're married. So it'll have both the husband and wife's information on there, but it's possible you'll see a return that they actually file separate. So it's up there where it says married filing separate at the top there. But generally speaking, there's going to be married filing joint. So at both all their income will be reported on one return. When they went back a few years ago to get to a postcard size return is when they changed it. And in their infinite wisdom, what they did is they ended up putting all of the details in a statement 1, 2, 3, 4, 5, and 6, and 18. And then in 2019, they shrunk it down to like 3 statements. So you'll see that, but those statements all give details to what lands on this page right here.
Okay.
Your most common, obviously, your wages will be there for your wage earner. Typically, they're just going to have wages and nothing else much going on there. That's where their money comes from.
So W-2 wages that will be, are they typically attaching the W-2 wages then, Phil?
Not anymore, but yeah, now what you do is when you electronic file, they're just entering in the information in TurboTax.
Okay.
Or their preparer is putting in. So it may have supplemental statements that have the details, or it may not.
Okay.
So when we do a return, will produce a statement. So if there's 3 W-2s, we'll have a statement that shows it, and then it'll total up to that line 1 there.
Okay. So yeah, so most, and just so you guys know too, on the tax analysis side, wages obviously is, what they're just taking home, and so it's an income item that we use almost every single time for sure.
Yep. It's bankers love wages.
Yeah, they love wages.
So, and then the next part, they put like the most common income items on the front of the return here. So these are the 5 most common that you'll see, where it'll be interest, dividends, IRAs, pension, annuities, Social Security. So your interest will be taxable, and then they have municipal bond interest will land here in 2A.
Got it.
But then the taxable interest will be here. These are your non-muni interests. So these ones here typically won't impact your AGI,
Okay.
or they won't. So that's just additional income. So that won't land down in your total income line. That won't include it, but it's here as a reference. There's a few times in the tax world where we need that AMT or some other random calculation, or there's some things where whether you can afford insurance, health insurance, there's all these add backs. So this gets used every once in a while somewhere else, but
so it's income but it's not being accumulated towards the bottom of the AGI. The taxable interest is, if I'm correct. And the reason why it's not the tax exempt interest is because they're just not doing, they're just not paying tax on it, so it's irrelevant.
Yeah, so municipal bond interest is not taxable.
Okay.
So that's, people will buy that investment, especially if they're in a high tax rate. You tend to see some more tax exempt interest.
Okay.
This qualified dividends really in 3A doesn't matter too much. It's just the tax rate. So the qualified will be included in the ordinary. So you might have $100 of dividends and 90 might be qualified, you still only have $100 of dividends. It's just qualified dividends are taxed at lower rates. So the
Like
total.
what's an example of that? Even like, obviously, I know dividends. So you're talking about like you getting a stock dividend or something, or what? What is that?
Yeah. So it'd be the lower tax dividends are things that are in the U.S. So you might have a stock that has investments in a foreign country, and so the stockholder is getting a dividend. So the dividend is getting paid to, let's just use an example. You buy Exxon, and Exxon has an investment in Germany in a stock. This German stock will come down into Exxon, and then Exxon pays it out. Well, that piece of it you can't get lower taxed on.
Okay.
It'll just be higher tax, but it'll all land on your brokerage statement. So that non-domestic dividend is taxed at higher rates. So this is only used, 3A is only used for calculating tax. It's not, again, it's like
It's not adding up. So really that is an irrelevant number versus the tax exempt interest is an actual separate item. It's just not ending up on the AGI.
Yep.
Okay.
So, yep, little different there.
And then one
IRAs, go ahead.
I was just say one final thing, just so you guys notate too. All of these really are going to, what your question you're asking on these from a tax analysis perspective is, are they reoccurring? So are you going to see this year over year, or is it a one-time sort of distribution thing, which is what he's going to talk about now, which is distributions.
Yeah, so the IRA distributions, this can get really distortive because this includes all IRA distributions, whether taxable or not. So it could be income and it doesn't have to be income. So I'll give you two examples. One example is just a rollover IRA. So if you take money out of one IRA and within 60 days you put it back into another, nothing changed. You just moved it to a new IRA account trustee. So it'll show up as here. So if you roll 100,000 of IRAs over and it's not taxable, it won't show up in 4B. It's just a rollover. So it'll just show up here. And it's, again, not necessarily income. There's just, because it's pre-tax dollars, it'll come out as taxable when you make distributions in 4B. So 4A may include that rollover. Second thing it may include is if you have basis. So an example of that is if you get a non-deductible IRA, post-tax dollars. So I put $5,000 into that kind of account. That account grows to 20,000. And I take that 20,000 out. I don't have to pay taxes on the 20 because the 5,000 is my post-tax dollars that I put in the account into a non-deductible IRA. My income is only 15,000. So the full 20 will show up here, but then only the 15 will show up as taxable because the 5,000 is my own money. It's my post-tax dollars. Most of the time, people have IRAs, they're pre-tax dollars. So they got a deduction when it went in. So they have to pay taxes on it when it comes out. So you're going to have both flavors.
And the taxable amount in the B section for the IRA distribution will be the amount you'll either use as part of your tax analysis, assuming that it's ongoing. So.
Yep. Pension annuities kind of act the same way. Pensions are usually, sometimes you'll find it where the employee will put their own money into the pension and there'll be a small variance. Typically not. That's like if you worked for Ford Motor Company and you worked for 30 years and then they have a contract with you that says after 30 years of service and you retire, you're fully qualified, you'll draw a pension for the rest of your life. And it's just all contractual based on the employee. You don't see many pensions anymore. Most people do 401ks and IRAs, but you'll see pensions every once in a while. And then annuity is a contract that you buy. Again, it's going to be pre-tax dollars and post-tax dollars. Some of it's your own money, some of it's growth. So the total will land in the 4C. The taxable amount will be 4D. So those get really messy fast, but because they're all contractual based. So it's just whatever contract you bought on the annuity. And there's hundreds of different kind of annuity contracts.
Annuities, yeah, so that's a drill down item, assuming that's going to be reoccurring or not. So that's good.
Yep. Social Security is self-explanatory. It's just when you retire, you get Social Security. There's a sliding scale, whether it's taxable or not. It goes to 85% taxable really quick. I don't know the dollar amounts. They're not usually my clients. But if you don't have any other income, your Social Security is not taxable. So it'll land here, the total distribution, and then the taxable amount will land here. The maximum Social Security tax is 85%. So anybody it's like 45 or 50,000 or something like that. It's a relatively small number that you hit that maximum. So that's just formula driven.
So then Phil, on the 5A section, if I'm doing analysis, then that's irrelevant because it's like you're duplicating if you're doing 5A plus 5B.
No, I think 5A would be a better number because that's going to be the total Social Security distribution.
Okay, got it.
So to me, in this example, 5A is more relevant than 5B.
Okay.
Because 5A is what you get.
Okay, makes sense.
So whether it's taxable or not is whether you make other income.
Got it. And then, okay, perfect.
Capital gains, there's a Schedule D. I'll just pull up a IRS form Schedule D.
And while he's doing that, yeah, the Schedule D is going to show you the capital gains. In almost all instances, they're not going to use capital gains for cash flow.
Yeah, I fight with lenders all the time on that one, on my clients, because I have clients that they'll do is rentals, and then they make a ton of money on the capital gains, and then they sell one a year, and then the lenders say no, we don't like those.
So they don't consider recurring.
So there's actually forms behind this as well, which the 8949. So the 8949 flows to Schedule D. Schedule D will have all the information. There's a few additional items that flow into here. 4797 is the sale of business assets. Yeah. There's some random investment, like these are straddle type investments. These are installment notes. So if you sell a business for $100,000 and you collect 20, the IRS rules say you only have to pay a tax on the 20. That's the only money you got. But then when you collect the other 80, it becomes taxable. So there's these other forms that kind of flow into here. Capital gain distributions come from brokerage accounts. They all kind of just come here. And then this totals down at the bottom to 21. And then that number. So it goes through all those different forms, lands on Schedule D, and then it lands. The total lands on line 6 there.
Again, 9 times out of 10, you won't use it, but once in blue moon, you might be able to make the argument.
Yep. And then this is where the IRS, in their infinite wisdom, wanted to create a postcard. So they made it really short with this half a page, but then they said, see Schedule 1. So Schedule 1 has a lot of relevant activity. IRS Schedule 1. And then these also have a lot of back pages, so they flow from multiple sources. But this is everything else. So there's taxable state refunds. It's if you got a refund in the prior year and took a state deduction, you got to pay the refund as taxable.
Not going to use that.
Alimony is kind of going away because under the 18 law, any agreements entered into in 18 or beyond are not going to land here anymore. So these are only going to be pre-2018 agreements where if you received alimony, it's going to land there. Anything from 18 and beyond is not going to even show up here.
It's not going to be taxed?
Nope.
Okay, got it.
So they got rid of it. And you'll see down here, they have alimony paid. So the payer used to get the deduction and the recipient used to have to pick it up as income. But
Now there's nothing on either.
now there's nothing except for old contracts. So if you had a divorce decree that was entered into 2017 or prior, it'll show up.
Okay. Got it.
And then that's why this date's here, date of divorce, because if it's 18 or beyond, then you kind of
Sort of irrelevant.
you'll see it. Yep. Business income is for those people that own a 100% of a business LLC, one member LLC, or they're a sole proprietor. So they work for themselves.
Like if we went a little bit through the 1120, but if you're the sole prop, you probably just do it on your personal with a Schedule C. I don't know if you can quickly pull up a Schedule C, just so they can see. So that'll be on a form, a separate Schedule C, and that's where you're going to run your business cash flow for those types of businesses. So to do like the net income, so here you go. So income, we kind of walk through that on that form, and then all your operating expenses, and then you get to your net income, net back, depreciation, rent expense, things of that magnitude on interest expense, rent, et cetera. So.
Yep. And then what's going to land here is only if you pulled up a business financials for a company, this would only have the income statement part. So this won't show any balance sheet. So you can't see receivables on here. You can't see whether they have assets or land or what kind of loans they have. None of that will land here. This is just going to be the income.
Yeah, it's good.
Corporations and S corps and partnerships have that kind of information, which comes relevant in the asset-based lending world.
Yeah. Right.
But this obviously won't show any assets, so you have to use outside internal reports to get all that, I suppose.
There we go.
4797 is the sale of business assets. This is going to be if you have an interest in a business and you don't own 100%, or it's an S corp. So partnership, S corps, trusts, they all have information returns, and then it'll summarize who's going to pick up that income. So for example, if you have an S corp with two partners and you made 100,000 gross, you had 30,000 in deductions, you have 70,000 net income, 50-50 partners. The K1's going to show 35,000 partner one or S corp owner one, 35,000 S corp shareholder two. That income lands here and taxed. So the S corp doesn't pay taxes. Partnerships, as a general rule, don't pay taxes. They just informational, and then all the taxes are paid on the shareholders level.
Can you show us a quick Schedule E, Phil? So again, because Schedule E, a lot of times, if they have real estate, and that's going to show you the income expenses. You're going to do the same thing there too, which is you're running income analysis. So net income, adding back depreciation, adding back interest expense, et cetera.
Yeah, there's going to be two parts to this. So page one will be that way, where you see all the rents and royalties. This is page one here. So it has all the income and the expenses here. But then page two is going to be where the K1s land. That's only going to show bottom line. That won't show the details. So you got to grab a copy of the S corp return if you're going to want to see the details. It's just only showing their share of income here. So in my example, that's the 35,000 of the income to shareholder one. It'll just show up here. It'll be in one of these boxes.
So like if they show loss, might not be an actual cash flow loss because they just had a ton of depreciation, but it just distributed out as a loss. So that's why you need to go back to the original return.
Yep. You got to go back and look at the partnership and S corp to really analyze that. So this will total the rents, and the K1s will total here, and then that'll land to this line right here. So this will be all of that kind of just lumped in together. Farm income is the same as this right here, except it's for farmers. So it's going to have the same.
So rarely you'll see that, but it can be income. Sure.
Yeah. Unemployment is self-explanatory. That's just if you get unemployment from the state.
And it could, again, that could be relevant depending on the length of how often that'll be. Some people have disability or unemployment for a long time, but it's rare.
Yeah. And then other income, you'll see stuff here quite a bit, but it'll be anything else that they can't find a spot for. So that's going to be like if you win something, like if you win a car, it's taxable, it'll land there. If you have net operating loss carryovers, it actually, believe it or not, shows up as a negative other income. So there's a ton of things that could land there. You just have to look at the statement to see what it is. Basically, if they run out of spots to stick something, it goes there.
Yeah.
And these here are, the way I look at it, these are just good deductions. You're digging into your personal deductions now, but they're above the line deductions. So these are the ones that as a tax preparer that I like to use as much as possible because they're the best. You get the best deduction for. But ultimately, these are all just personal deductions of one flavor or another.
Now, all this is really doing, I mean, it's okay for you to look at. It's not going to be really too relevant in terms of the cash flow, but at the end of the day, you know, from a tax perspective, it lowers your tax basis or what your taxable income will be because it's going to hit your AGI.
Yep. So we like to play around in planning for this, where like retirement accounts are here. You know, if you move in armed forces, health savings account deduction. So yeah, there's quite a few here that are good. This then flips back to 7A, the total of all that.
And then what is the 7B? So you're adding back all these items to get to the total income then?
Yep, 1, 2B, 3B, 4B, 4D. So these are just totaling these all up.
Okay.
Yep. In the 18 year, they didn't total. They just had to figure it out. But then 19, they kind of helped. So yeah, this is just a sum number here.
What's the adjustments to income schedule?
That's this number. Oh, did I close it? That's the 10 through 22.
Okay.
Will land.
All those adjustments that we can
it'll land right there. So this is the 1 through 9 of Schedule 1. These are the rest of the bottom half of Schedule 1.
They're really not applicable for you because you're already going to just be adding the items up. So it's not really relevant for tax analysis.
Yep. And then these are just done. After this, it's just calculations. So you get your adjusted gross. This is after good deductions, if you will. You get adjusted gross. And then you get the bad deductions, which are here. These are subject to all kinds of limitations. But this 8A and 9 and 10, they're all just deductions, just different tax benefits. 8A is the best. Actually, 10 is the best because 10 are deductions you don't even have to pay for. It's just something they threw in there for business owners. Essentially, if you get a K1 for $35,000, there's all kinds of limitations. You can deduct 20% of that K1. So that would be $7,000 would land here as a deduction that you don't have to pay for. So in their infinite wisdom, they're trying to tax business owners less instead of just taxing at a lower rate. It's just algebra, right? They're just going to tax it 100% here, but then back up 20% here. So essentially, you're taxed on 80% of your K1 income at the end of the day.
Almost sensing some sarcasm in your infinite wisdom comments.
Yeah. They just like to the rules for that are like 90,000 pages of stuff to get through it. So they just like to make things really complicated.
Keeps people employed.
That's right.
So then you got your taxable income. So that's how much they're going to get taxed on. And then when you scroll down.
Yep. Then that kind of calculates this is the tax, and there's all kinds of capital gains and qualified dividends are taxed at lower rates. And there's a couple of other things like collectibles and things like that. So there's several things that go into the formula. Whatever it is, it all totals up to here.
To 12B. Yep.
And
you get your child tax credits.
This is where people like me get real good. I get
babies.
Yeah, I get $16,000 there because I have 8 kids. So that times 2,000 goes there. So that's just they did away with the exemption in 18. and they used to be able to take exemptions for the amount of people that you claimed. Well, that's gone now. So the whether you claim people or not is now gone. So you can claim them, but you get nothing for it. For a deduction. So what they replaced it with was this increased child tax credit, and it phases out. So the rich people don't get it, but us poor people get it. So that reduces there, and then Schedule 3 is going to be credits, additional credits. I can kind of quickly run through that.
So credits to get, and the number that's ultimately going to matter is like how much.
Yeah, foreign tax credits, child care credits, education, retirement. If certain people, if they contribute into a retirement plan, they have low income, the IRS gives them a credit. This is for like your solar panels will land here. This will be things like R&D tax credits, or restaurants get a credit for tips paid. There's some premium tax credits for if you go through the marketplace and get health insurance, you can get credits for that. If you have 2 jobs, there's a Social Security max, so it's like 130,000. Well, if you have 2 jobs, they're just going to tax all of it. And then, so if you have 150,000, 130 in one job and 20 in another, you paid too much Social Security, they'll give it back here. This is fuel tax on credits. That's like over the road truckers and things like that, that they get credits for taxes paid on their fuel. So all those credits will land here and then just total to the return. To right.
13,
yep. And then they add back all kinds of extra taxes. So there's people that pay additional taxes. So you'll see stuff here. So these are tax. So you have your income tax, and then you have other taxes to add on top of it. So AMT is, I won't get into that. That's just additional tax for rich people. If you get too much credit on your health insurance, you got to pay it back. So if you tell the IRS you're going to make 40 and they calculate your credit, and then you make 80, you got too much money, then you have to pay it back. This is, if you're a W-2 employee, you pay Social Security Medicare on your W-2. If you're a 1099, you obviously don't have withholding, so you pay that Social Security Medicare here. So so if you look at your W-2, you'll see withholding, but if you look at 1099, there's none, so you just got to pay it there. If you take money out of an IRA too young, you got to pay it there. If you have a nanny and you have taxes as a result of a nanny, it goes there. And there's some other stuff, I won't dig into it, but there's just any additional tax above and beyond income tax will flow there, and it'll total there in line 15. So that totals it, and then comes your payments. So you have your federal withholding will be, if you take taxes out of your paycheck, it'll land there. Earned income tax credits are, these are refundable credits. So these will be credits even if you don't have taxes. So this could be 0 and you could have credits here. So this is if you make too little money, they give you an earned income tax credit. This is if you have 2,000 here, but you don't have enough money to bring it, they'll give you additional credit here. So if you only have enough tax to get 1,000, because your taxes here calculate 1,000 on line 12B, obviously it's going to only put 1,000 here. This will go to 0, a total tax. But then they'll say, hey, since you didn't have enough, we'll give you a $1,000 refund as well. But this 8B and 13A will total the $2,000 per kid. This is for education, if you pay for tuition. And then it just gets into the payment. So that's kind of the summary of the 1040. And then if you pull up a tax return, a complicated tax return will be 100 pages long. All of those other pages are support. So everything lands in these 2 pages that we went through eventually.
So everything's supporting, that's why you can reference the schedules in here. Some of the key things to remember, so that's really good, Phil. Thank you for that. So some of the things to remember is that, is the income recurring? So that's important to understand. Is this ongoing reoccurring income? Capital gains generally aren't going to fall into there. You know, distributions, IRA distributions probably are going to fall in there, although if they hit a certain age, they might. You know, dividends may or may not. So we're just kind of asking, is this reoccurring, ongoing? We've gone through some of those items. And then obviously you want to make sure you're looking at the tax, because they're going to deduct that tax out because that's what they have to pay ultimately as part of your cash flow, because they actually have to cut a check and pay these taxes. So you make sure you're pulling that out as part of their, you know, if they get a refund, you know, they're not going to get benefit for a refund, because again, that's not recurring income ultimately at the end of the day. So yeah, this is the, you know, 1040 sort of summary, you know, for Integrity Capital, just trying to get you familiar with the 1040, because you'll be looking at them all the time or doing tax analysis. So Phil, we really appreciate you taking the time. I know it's been a long day, so thanks for doing that for us, brother.
Yeah, absolutely. Happy to do it.
I'll see you here in the next couple of days.
Okay, we'll see ya.
All right, thanks.